Today, we're opening an investigation into a place you trust with your money, your bank. Because that trust, well, it may be the biggest leak in your financial life.
Let's just get straight to the evidence. What you're looking at on the screen is the core of the problem. What a traditional bank pays you on $10,000 versus what you could be earning. We're talking $1 against more than 450. The question isn't just why this gap exists, but what it's really costing you.
So, our investigation is broken down into 3 chapters: the death of the reserve, the COBOL tax, and a much-needed Dodd-Frank reality check. All right, let's get into it.
First things first, we have to completely dismantle a myth, a foundational belief most of us have about banking, that banks take our deposits and then lend that same money out. You'll see in a second, that's just not how it works anymore. This is the technical detail that changed absolutely everything. In March of 2020, the reserve requirement for banks was dropped to 0%. That means they are no longer required to hold any of your deposits on hand. They have other, easier ways to get cash. This one little policy shift completely shattered the old model. And here's the crucial takeaway from that. If banks don't actually need your deposits to make loans, they have zero incentive to compete for your money with high interest rates. It completely changes your relationship with them. You're no longer a customer they need to win over. You're a donor, providing them with free capital. Now, to really understand the real-world cost of all this, let's look at the numbers.
Exactly. I mean, take this $10,000 on the screen. We're all conditioned to see that as a fixed, safe number. But you know what? That's an illusion.
Right now, with inflation at, say, 3.1%, and your bank paying you a measly 0.01%, your wealth is being silently sliced away every single day. It's not a big, noticeable chunk. Nope. It's a thin slice, then another, and another. It's the financial version of salami slicing.
This slide here translates that abstract percentage into tangible things you can feel. Your money isn't just sitting there, it's actively shrinking. By Tuesday, you've lost enough to buy a candy bar. By the end of the month, a dinner for 2 is gone. This isn't a risk of loss, it's a guaranteed loss.
Okay, let's move on to our next chapter. This part exposes the operational reason for this massive gap. It's really a story about ancient technology and a hidden tax that you're paying because of it.
So, when the Federal Reserve raises interest rates, you'd think your bank would follow suit pretty quickly, right? Well, modern online banks, they typically pass those higher rates to you within 48 to 72 hours. The big banks, they take on average 18 months. This lag isn't an accident. It's a period where they profit directly from your inaction. This strategy actually has a name. It's called managing deposit beta. Their entire goal is to keep this number as low as humanly possible. That means they get to absorb all the profits from higher rates while passing almost none of it along to you. It's basically a tax on your loyalty and your habits. And this image, man, this perfectly illustrates the why. So on the left, you see the reality for big banks. Huge, inefficient systems, a lot of them still running on programming languages from the 1960s. All that overhead, the physical branches, the marble lobbies, the old systems, it's all paid for by keeping your interest rates near zero. Now compare that to the lean, cloud-based model on the right. They have way lower costs, so they can actually pass the savings to you as higher interest. All right, in our final chapter, we're going to escalate things. We're moving on from just lost interest to a far more serious topic. The actual risk to your principal, hidden deep inside the very regulations designed to protect the system. We've all heard of taxpayer-funded bailouts, right? Well, the Dodd-Frank Act created a brand new model for big failing banks. It's called the bail-in. And what this means is that in a crisis, the bank can use its creditors' money to save itself. And as we're about to see, that can include you. This is a direct quote from the source material, and it is a critical distinction. See, FDIC insurance covers you up to $250,000. But every single dollar you have above that limit in a single bank, it literally makes you an unsecured creditor. You are literally loaning the bank money with very little protection if things go sideways. And check out this visual. It shows the stark difference in protection. A standard big bank account, you're insured up to the usual $250K. But a lot of modern high-yield savings accounts use something called sweep networks. They spread your money across multiple banks, which can insure you for up to $8 million or even more. The irony is just incredible. The supposedly safer big bank actually offers far less protection for larger balances. So this brings us to the final myth we need to bust. This whole idea that moving your money is slow and difficult, and that big banks are worth it just for the convenience. Let's put that theory to the test.
Thanks to modern payment systems like FedNow and real-time payments, that excuse is officially obsolete. We're showing you the proof right now on the screen. 11 minutes. That's a real test we ran from a high-yield account to a major bank on a Saturday evening. The convenience barrier, it's gone. The solution, then, is pretty straightforward. The first steps are simple. 1. Audit how little interest you've earned. 2. Calculate what we call the lazy tax. That's the money you're losing by not moving. 3. Verify the FDIC status of a new, higher yield account. And 4. Open it, which honestly takes less than 10 minutes. You know, ultimately, it all comes down to this one question. Is your bank a partner, actively working to help you build wealth? Or, based on all the evidence we've seen, are you simply a donor, funding their operations for free? Your answer to that question determines your next move. And to help you make that next move, we've put the full bank liberation checklist from our source material right in the description below. It's a step-by-step guide to reclaiming your capital and making it work for you, not for someone else.